What's up, Banter fam? I'm your host, Miles. Welcome back to the show. Right now, we are getting massive movement in the Bitcoin price. So I want to talk about some key levels that I'm seeing on the chart and whether we are going to bounce on this support or whether it looks like we're going to break through ahead of CPI data tomorrow. I'm also going to talk about a big narrative that I think most of you probably don't have exposure to, but I think it's something that a lot of people in DeFi are actually ignoring and probably should have exposure to, or at the very least know about. So I want to be talking through that narrative, and that narrative relates to tokens that actually accrue value in stablecoin ecosystems. Typically, people view stablecoins as this boring topic because they trade at parity to the US dollar. But in reality, it's opening up the doors for massive gains in terms of tokens that actually accrue value off the back of stablecoin adoption. So we're going to take a very interesting angle in today's video and dive into the tokens that I think can actually benefit from that narrative. But let's get into the charts before we get into that talk, because there's quite a lot happening at the moment, and that actually occurred overnight. So we are seeing right now the Bitcoin price hovering at the very low ranges of this support. Now, at the moment, I have drawn in this support line from the body of the original candles down here. And if we draw in this support, we can see that technically we are still printing higher lows. So we can see here, that's technically a higher low. Here, that's technically a higher low. And then now the new candle forming on the 4-hourly is technically a higher low. However, if you do want to draw this support line in from the wick, you can see that technically we have broken support. So what is the correct way to actually draw it? Well, I'm viewing this support line as actually a confluence point to the horizontal. So by far the most important level right now is not actually the support line. It's the 1925 region to the 1959 region. This is the green support zone, which has been holding up, but only just, and in the past has been typical support and resistance. So this is the main zone that I'm looking at us holding if we want to keep above these levels. Otherwise, it's very, very, very likely that we not only come down to the 18.6 region, but then we also come down to the 18K region. So the support line I am looking at, and also the one that Kyle drew in on the daily candle, this support line is a confluence point for me personally. So it's a point, it's a region that I am looking at to substantiate the greater move down, and also substantiate whether we still are in a bull trend on the short time frame. So I'm going to look at the hourly right now, which, as you can see, we are still printing higher lows, although we are now at the bottom of this support range. Technically, there is a path out of this mess, and the path out of this mess would be a bounce on support. We can even break under it for a little bit, and then try and push up to this 20K region, which has been, another region of resistance. We can see I've drawn the range in, for the mid-range, which is around the 19 to 20K mark. So that is potentially a scenario where we keep printing higher lows and we can actually break out to the upside. But then there is another scenario, and this scenario is honestly looking more likely in the short term, given the overall macro trend with the CPI tomorrow, and that is that we actually struggle to break out of this zone, and that we can break to the downside, and that would result in either an $18,600 Bitcoin or a 17.7 to 18K Bitcoin. Now, this scenario would obviously, be a breakdown of support, and this scenario would be a decent short play. So if you're actually a trader and you're looking to trade in the short term, this can be a decent opportunity. You'd want to look for confluence points. So what I mean by confluence points is not just trading on one set of data. Whenever you trade, you want to look at multiple sets of data in order to substantiate a particular trade. So if you're just trading on the break of horizontal support, that's not going to be as strong as if you're trading on the break of horizontal support and the break of the diagonal trend, because that is a much, much, much stronger confluence point at that point. You'll also notice we have the 50 and the 100 EMA starting to tick down towards the 4-hourly. If we did hover in this range for a little bit longer and these started to come down, we can see the RSI is already relatively bottoms, then that could potentially be another point to look at shorting the resistance. Although these MAs will probably take a couple days to come down. And the thing is, we know that the macro has a lot of huge events over the next few days. Tomorrow we have the CPI data coming out, which is probably the main primary driver behind this, recent price dip. So that's something we do have to keep our eyes on. Now, if we move to the daily, we can see we are still forming these bearish flags, or bearish pennants, as they call them. And this is probably the most damning chart of them all. And I showed this on yesterday's show, but we can't really ignore this. And it's the fact that we've been accumulating in these pennant formations, dumping when the RSIs hit the top. So we could see in the orange, I've circled, when the RSIs are topping. When they top, we seem to dump. go through an accumulation phase, as we saw in the 30K range. Then the RSI tops again, we dump. Then, we start to accumulate in this range again, and then the RSI tops again, and then we dump. Now, I'm not necessarily saying it will happen this time, because we know that on the 4-hourly chart, there is a path out of this mess, but we are now on the very bottom of support. So if we do break below this support, then we know that the next targets can potentially be as low as 14K. Now, it's also a chance that we continue to make a higher low just at the 17.6 region. Technically, that would be a higher low, and technically, you can then readjust this support line. But at some point, a breakdown does become inevitable if we follow this bearish pattern. So it really depends how the market wants to play out. If there will be a reversal, and obviously that means a push up to the 23K mark, or a push to the downside and a breakdown of this support line. So to determine which one's more likely, we got to go back onto the shorter time frame. And honestly, right now, it looks like a breakdown to the downside is more likely than a breakdown to the upside. That's just, my logical representation of the situation, given what is happening in a macro perspective. Now, if the macro was great and the CPI data comes out, fantastic, and some of these China fears start to ease up, and the Fed comes out slightly more dovish in the next FOMC meeting, then yes, that can totally act for a catalyst to push up towards this mid region. However, until then, and that very well may not happen, then a breakdown to the downside remains more likely, because we do want to follow the trend here, and we want to follow the trend of the market and not be too sporadic in trying to guess reversals, because guessing a reversal is a lot harder than playing the trend. As Carl says, the trend is your friend till the end of the trend. And right now, on the daily, the trend is clearly down, although on the short time frame, higher lows mean the trend is upwards, but just because we are at the very, very, very bottom of support right now. So that is potentially a shorting opportunity. If you did take the initial short at the top of this range, I pointed that out on yesterday's show, then you'd be currently up 2%. Let's say you use 10x leverage, that would be a 20% trade. So to anyone that actually did get on those shorts, good job. That wasn't the big short. That was just a little bit of a scalp trade that you guys could get on. But the next big trade is the breakdown of this horizontal support in confluence with this trend line. So just keep your eyes on that for a potential play to the downside. And then the Bitcoin dominance is another major factor right now. Let me just delete this line here. We can see that on the 4-hourly, and you can also draw this on the daily. We have just broken diagonal support. And we seem to be retesting, which is weird because it indicates that the dominance is breaking down versus the market breaking down, which means Bitcoin is losing relative strength compared to altcoins. So over the last few days, it has been gaining a bit of strength, but since July 8th, which is 5 days ago, it's actually been breaking down slightly since its local top in the 44.6 region, which indicates that Bitcoin is actually being sold off a lot more than these other assets, because obviously, there's a few contributing factors for this. There's the Mt. Gox fears that have been doing the rounds. There is liquidation fears. Obviously, a lot of big institutions, a lot of big lenders, they primarily hold Bitcoin and Ethereum. So these assets have taken a hit. I do expect the discrepancy between Bitcoin and altcoins to kind of dissipate over the next few days. That's typically what tends to happen after these Bitcoin related dips. But it's very interesting to note because, if we actually do get a breakdown off the rejection of this support, then the next support line for the Bitcoin dominance is actually closer to the lower 40s. We could see it's like minus 3.4%, and then the next level is minus 5.18%. So keep your eye on the Bitcoin dominance. That's potentially something we have to keep a look at in terms of how that's going to affect altcoins, because a breakdown in the Bitcoin dominance, although that's technically good for alts, I don't want to see that. I actually want to see a strong Bitcoin dominance, because that would indicate to me some liquidity coming back into the market. So this trend, maintaining the higher lows, would be a much more favorable trend for crypto, in my opinion, provided that this happens off the back of increased Bitcoin buy volume and not Bitcoin sell volume. If this happened as a result of sell volume, then that means the market's collapsed, and that's not what we want. So just keep your eyes on the Bitcoin dominance to see how it reacts to this level. And obviously keep your eyes on the Bitcoin chart to see how it reacts to this diagonal support and the horizontal support as well, because we know this is a major, major area now. Remember, if you guys do want to trade, there's a link to ByBit in the description. We're giving away $4,200 as a sign-up bonus if you sign up, depending on the amount you deposit. And we're also 10xing people's accounts live on the main show. I think Rand's away for a few days, but he's going to start commencing that when he's back, obviously. And yeah, we'll be 10xing accounts for people that sign up, lucky people's accounts. And there's also the $4,200 bonus. So if you're not already signed up to ByBit and you do want to trade, I highly recommend signing up. using the link in the description. It also helps support the channel, which is very nice. But what we kind of have to look through now that we've kind of gone through the charts is the exact reasons why the charts are acting bearishly. Because obviously, there are some macro uncertainties, but I think the major topic to discuss in terms of the charts is this CPI tomorrow. The market is very panicky about this CPI because the forecast actually came in significantly hotter than what a lot of people were expecting. So I think some people were expecting like a 1% increase month on month. There's been reports that it could be as high as 1.5%. So that's got the market a little bit spooked, and we're seeing a pre-sell-off here. Alex Becker has a theory. His theory is that that the insiders and Wall Street are actually trying to cause a dump, and that if it's not brutally apparent, they know CPI will peak tomorrow and are trying to cause the final shakeout before it reverses. I don't know what is, because there's been a lot of coordinated FUD coming out from Wall Street and, a lot of insiders and these kind of media outlets saying, they're expecting things to get a lot worse. They're expecting inflation to come in very hot. And this is clearly spooking the market, because obviously if CPI comes in hotter, that means, the Fed has more of a license to execute QT and also execute higher rate hikes. The estimated rate hike is 75 basis points in the next FOMC meeting. So there is a little bit of uncertainty about, if the CPI comes in quite high, that is obviously negative for Bitcoin, because Bitcoin doesn't survive in highly inflationary environments because it needs low interest rates. So as long as interest rates are low, crypto does well. But if high inflation gives the Fed license to increase interest rates, then that's negative for crypto as a whole. But here's the major caveat to this, and here's the major thing that you need to note. CPI is backwards looking. So the CPI data looks at the previous month, the prior month. Now we know in the prior month, commodities, energy prices, all these things were actually spiking. So we know that the data for this particular month will be particularly inflated, which is why we're seeing a lot of panic over higher inflation data. However, if we look into the future, we know that next month's CPI will be backwards looking on the month of July. Now we know the month of July is reflecting lower oil prices, lower energy prices, and lower commodity prices. So this would indicate that this CPI could potentially be the top of inflation, the Pico top, at least in the next 6 months of the CPI data. And this top would suggest that this is kind of like the worst it gets for inflation. Now, this would obviously be a bullish thing for crypto if this was the top, and then every single next CPI was like a minus 1%, on today's CPI, because that would mean the Fed has more license to pivot. So what I am seeing is definitely bearishness in the short term surrounding the CPI. Bearishness maybe over the next couple of days, maybe once the CPI is announced, things won't just rally, because it probably will be very, very hot and the Fed will probably come out very, very hawkish. But then what I'm expecting is a little bit of an easing in that tone as time goes on, as we start to look at past data and we see these numbers starting to come down, because it is backwards looking, which, obviously there's a discrepancy there. So that's just something we need to keep in mind. Now, Pantoshi said he feels like earnings are more important than CPI. Now, we know that company earnings, so Amazon, Microsoft, Google, all start to announce their earnings towards the end of July and the start of August. He says that actually is more important than the CPI. We already know CPI is going to be higher than last month. Like, that's basically a given that it will be. I think the estimate's 1.2 to 1.5% higher than last month. He said people will say it will come as expected, but what's important is that it's still too high regardless. And yes, it will be extremely high. And July 19th is where the big names earnings seasons kick off. Now, if the big names come out and they announce weaker earnings, this obviously impacts growth stocks. This impacts things like Amazon, Microsoft, which have such a large percentage contribution to the NASDAQ. Now, since they're so heavily weighted in terms of these, like the NASDAQ and the S&P 500, what will actually happen is these entire indexes could be dragged down if there's poor earnings. And we know how correlated Bitcoin is to these indexes, which obviously means crypto could take a hit if earnings are bad. If earnings are good, or at least above or in line with expectations, then that wouldn't affect Bitcoin prices too much. So these earnings data is very important to keep our eye on, as well as the CPI. Now, we know how risky the month of July is. We just know how volatile this is. This is why this is a very difficult market to trade. And I said in my Twitter, if you could trade this market and come out ahead, the bull market will seem like an absolute breeze. So if you're learning to trade, you're actually 10 times better off learning in a difficult market as opposed to an easy one. An easy market like a bull market will just kind of gift you handouts. A difficult market like this choppy sideways market with all this macro news coming out and these impossible ranges, that is actually a much better environment for you to learn in. It's kind of like learning how to play soccer with a tennis ball. The ball's a lot smaller. It's a lot harder to control, but you're actually going to work on your footwork. You're actually going to work on your ball control, your agility, your stamina. And then by the time you get the bigger ball, it's going to be a lot easier to play with. It's going to feel so much easier because you've already adapted to the smaller ball. That's exactly the same as it is in crypto. If you can adapt to such a sideways, choppy market with so much negative macro news and just so much volatility, then by the time things get a little bit easier and we see much clearer patterns on the charts, and the macro eases up and we go into at least an accumulation phase or even potentially a macro bull trend, then it becomes a lot easier to trade, because then all you're looking at is breakouts and key horizontals, and trading those markets is a lot easier. Like, we know how easy the bull market was to trade comparatively to this sideways choppy market. And that's because down markets have a lot of fake outs. And although bull markets also have fake outs to the downside, the amount we've just seen over the past couple months is absolutely crazy. And there's just time and time again luring investors in, as we could see, like this pump here, fake out. This pump here, if you actually draw the horizontal, that's a fake out. And then we got, a couple more in recent times where it looks like we're going to push past 23K, faked out again. So it's a very difficult market to trade, but this is actually your training time. This is the time to get serious and to actually learn the skill if you do want to learn to trade. Now, obviously, I'm more of a fundamentals guy. I'm not an expert trader, but it's something I'm trying to learn, and it's something I'm doing a lot more of. And I'm trying to really absorb the information I can learn, because I want to get a lot better, because by the time the bull market comes around, we'll be very well equipped with these skills in order to succeed. So that's kind of like my little spiel on trading before I get into the main topic of this video. Remember, you can sign up for a ByBit account, link in the description if you do want to trade. Help support the channel, and you also get the $4,200 bonus. All right, let's talk about the major narrative of this video. And the major narrative of this video is stablecoins. Now, we know stablecoins are the fastest growing sector in DeFi. So if we actually look through CoinGecko, we can see just how much the total stablecoin balance has actually grown. Stablecoins now account for $153 billion of market capitalization. This is more than 10% of the total crypto market right now. For comparison, last year, this was only like 3 to 4%. So relative to the crypto market, stablecoins have almost tripled in their market capitalization, making them the fastest growing sector in DeFi. Now, we can see that there are a few major stablecoins which have obviously risen to prominence. We have Tether, which is still the biggest at 66 billion. We have USDC, which is gaining steam on Tether. We can see that that's actually increased by 3% in terms of market cap, while Tether has been declining in supply. We know BUSD is very popular, and DAI as well. And we've seen multiple stablecoins kind of starting to pop up, some algorithmic stablecoins. UST was obviously a failure in the end, but there's been other ones like USD.D, which are popular, USDN, which are popular, etc. However, you can't actually make money from this, right? If you invest in Tether, you can't actually make money. If you invest in USDC, you can't actually make money, because all you're doing is you're buying a stablecoin. So that the intention of a stablecoin is to keep one-to-one parity with the US dollar. So if you're investing in USDC, you shouldn't expect to make money on that, because it's supposed to keep pegged to the US dollar. So how can you actually benefit from the growth of stablecoins? We know that stablecoins have tripled over the last year. We know that the market cap of stablecoins continues to increase as it grows as one of the fastest growing sectors in crypto. So how can you actually play that narrative, and how can you play that narrative to your advantage to profit? That is a major question. Now, I have a few responses to this, and I have a few plays which can actually help you get exposure to this narrative, because a lot of you will, that stablecoins are a massive growing industry, but beyond L1 exposure, you probably don't have exposure to the stablecoin growth themselves. Now, no, you can't invest in USDT. No, you can't invest in USDC. But there are some other great stablecoin ecosystems which you can invest in. Now, this doesn't mean you're investing in the stablecoin itself. It means you're investing in the ecosystem. Let me give you a couple examples of this. Rec Diomedes, I highly recommend checking out his Twitter, did a great thread on this. Basically, the biggest stablecoins you can actually invest in, not just stablecoins that you use to trade. And he said he thinks stablecoins are clearly the stickiest use case for crypto DeFi, and I would tend to agree with this thesis. And he sincerely believes that one day we'll have trillions of them on chain. Now, this is trillions of dollars of them on chain. Obviously, right now we have $153 billion. Now, if we have, let's say, 2 trillion, this is more than a 10x from current levels. Now, a 10x in the total stablecoin market cap would obviously mean that the ones that accrue value will perform extremely well. So which ones actually are accruing value? Because these are the ones we want to add to our watch list. Now, the first one he points out is BUSD. Now, BUSD is a stablecoin. It's pegged 1-to-1 to the US dollar, obviously. And for every dollar worth of BUSD, there's a dollar worth of fiat currency in the reserves. Now, BUSD has a larger amount of reserves in cash and cash equivalents than other stablecoins, because other stablecoins, keep a large percentage in like treasury bonds, and whereas BUSD is more keeping actual fiat. So it has cash equivalents and cash reserves of up to 96%. And USDT only has 2.9% of its reserves in cash, because it uses other assets like obviously bonds in order to tie up its equivalency to the US dollar. So as a stablecoin, obviously this means it's 1-to-1. Now, BUSD, by investing in it, you're not directly getting exposure to the narrative here. What BUSD does is it operates on the Binance Smart Chain. Now, obviously, BNB then becomes the major token that you would need exposure to benefit from BUSD. And this is not an obvious value accrual, but it's a broader value accrual related to L1s, which I think is important to touch on. And that's the more BUSD grows, the more market cap it grows. Let's say, it gets to, $100 billion market cap. Then this means that obviously, since it resides primarily on the Binance Smart Chain, this will mean more users come to the Binance Smart Chain to take advantage of not only holding, but trading the BUSD token on the BNB DEXs, and then also staking that token in the BNB DeFi farms. So it doesn't have a direct value accrual to the L1, but it does have this indirect effect of the more, let's say, BUSD grows, the more the Binance Smart Chain is used, the more its market cap theoretically increases. So it's not, a linear value accrual, but it's definitely a loose one, and it just adds to the use case of an L1 like BNB, which I actually do like, and I know a lot of, the other analysts at Banter really do like BNB as an investment. So I certainly can't fault a BNB L1 exposure as a bad way to get exposure to the stablecoin ecosystem. DAI and Maker, this is the next one. We know Maker's like that borrowing and lending platform on Ethereum. DAI is kind of their major stablecoin. It has a market cap of 6.4 billion. It's over collateralized, unlike a lot of other stablecoins, which is quite unique. It's actually collateralized at 134.92% relative to its value. So obviously DAI sits at $1. Maker protocol is pretty fascinating, in my opinion. I don't love it as an investment just because I think there are better plays. However, it does accrue value fairly well from this DAI setup. So because people borrow DAI on Maker and use Maker to obviously, put up assets as collateral in order to loan stablecoins, it does have decent value accrual because, this increases demand for the DAI token, increases the amount of transactions that happen on the Maker platform. Now, you can't really fault Maker's price, although it has dropped from like $5,000 to $1,000. You can't fault how it's actually held up in this bear market. If we look at DeFi Llama, it actually has performed quite well in terms of both TVL and transaction volume relative to a lot of other platforms, because it is on Ethereum. It's one of the original DeFi protocols, and it's very, very utilized. And I do view DAI as one of the safer DeFi stablecoins, and I like it as a stablecoin, but I also think that exposure to Maker, although it's not my favorite play in this video, it's definitely one way of getting exposure to the ecosystem. And DAI actually is, a pretty solid performing stablecoin. If we look at DAI and we go down to its market cap and we look through its price performance, we could see that despite, a recent reduction in the DAI supply, it actually has grown quite strongly. And this trend remains bullish over time. So, DAI has clearly been growing, did top out in April due to the decreased amount of demand side pressure for using the Maker protocol. So there was less people demanding to borrow the DAI stablecoin because there was less money going into DeFi. However, it's actually held up pretty damn well considering the market conditions. So that's just one more that I think we got to look at in terms of getting exposure to the stablecoin narrative. Now, this one's probably my favorite, this next one, and this is FRAX via FXS. Now, there's some Giga Chad moves here. There's some massive, and I really have to do a future video on it because there's some very big moves that the FRAX team's actually using. I think Sam is one of the smartest guys in crypto. I honestly do. If you don't follow him, highly recommend following him. He's the founder of FRAX, and he's basically teamed up with Curve and Convex to create a little bit of a powerhouse video. So I'll just give you the TLDR, the quick rundown on how it works, and then probably in a future video I will give you a larger, more comprehensive rundown of how this value accrual actually works. So if you guys don't know, FRAX is a partially collateralized algo stablecoin. So it's backed by 80 to 90% by other assets, and then 10 to 20% is backed by FXS shares. So it doesn't have a death spiral like UST or Luna. It is backed by other assets, and a percentage of it is backed by the governance token, the FXS token, which is the token of the FRAX network. What FRAX actually is a stablecoin that is essentially utilized across multiple DeFi protocols. Now, Sam has done an amazing job of building out the treasury with its protocol-owned liquidity, and essentially finding use cases and utility for FRAX, because the main issue we find with stablecoins is these algorithmic stablecoins, especially the ones that aren't fully backed or over collateralized, they end up crashing because there's no utility. And, if there's no demand for a stablecoin, there's no real use case, then obviously that's going to, unless it's one-to-one backed with a treasury, then there's nothing underpinning its value. Now, what Sam is doing is he's pivoting to basically become the most utilized and the most relevant stablecoin in these DeFi ecosystems like Curve and Convex. So Sam is really pivoting to, add real utility to the FRAX ecosystem. Now, we know FXS, which is the governance token of FRAX, is the one that actually accrues value. So the more FRAX is utilized, the more FXS is actually burnt. So the more FRAX actually gets adopted across more protocols, the more TVL that is deposited into Curve Finance in order to stake FRAX and in order to get involved with the FRAX pools, the more emissions are directed towards FRAX, the more emissions are obviously directed towards the FXS holders, which are the ones that benefit from the value accrual of the FRAX token itself. So it's got a very linear value accrual, unlike the BNB and the BUSD accrual, which is kind of like a lot looser. It's basically a bet on on-chain adoption. FRAX is very, very, very linear, because we know that emissions are directly paid to FXS holders, specifically VE FXS holders, the ones that stake FXS. It gets a little bit complicated with the tokenomics. There is a great thread on this, and I highly recommend checking it out. It's by Haim Salomon, and he says that there are moments in your life where you realize everything's about to change forever. Understanding FRAX XBP is one of those. 2 new protocols were posted yesterday. The future's becoming clear. It's essentially, as a TLDR, a collaboration or a partnership between FRAX Finance, Curve Finance, and Convex Finance. Now, I think it's absolutely massive news. And essentially, there was a governance proposal which allowed FRAX Finance to take a massive part in the Curve wars. And there's been a lot of speculation that FRAX could actually win the stablecoin wars on Curve due to its dominance in these liquidity pools. There's been a lot of discussions about what this means. Is it good for FRAX? Is it benefit Curve? Does it benefit Convex? I think it supercharges all three, as Haim kind of contends here, but I do think it has the most direct benefit on FRAX itself, and obviously that means FRAX holders itself. So I highly recommend reading out through this thread. It gets quite complicated, but essentially what the proposal outlines is they're deploying a FRAX USDC pool on Curve. They're securing a gauge for it, which means the more votes that are kind of geared towards it, the more FXS holders actually earn. They're converting FRAX USDC to a base pool, and there is a VE Curve whitelist for FRAX holders. And this was a few days ago now, so by now a lot of this should already be live, as part of the rollout of this proposal here. So I think it's absolutely massive. I highly recommend checking out this thread. I think it was one of the biggest DeFi updates. One I'll do a whole video on, because it's so complicated that it would take me like 30 minutes to actually fully explain it to you guys. But if you do want to read about it in the meantime, Haim does a thread on it here. But the TLDR is FRAX coin equals good coin. Or FXS in particular, because that's really, the best way to get exposure to that narrative. Now there's a few other narratives that Rec points out in terms of stablecoins. That's USDN, which is Neutrino by Waves. I'm not a huge fan of this. USDD via Tron. I'm not a huge fan of this. I just don't really like Tron. I think it's too death spirally. I think it's got too many similarities to UST. I'm not a huge fan, despite the fact that it's up 15% for the week, despite the fact people seem to love accruing, depositing into Tron, and the TVL keeps exploding. I'm just not really a huge fan of it personally. Rect mentions a couple others. He mentions Faye. Faye lost peg for so long that I don't have that much trust in it, although they are making pretty big moves, so it's a higher risk-reward play. And he also mentions a couple others like Mim via Spell, which I don't love, but he's mentioning them not because he loves them, he's mentioning them because these are tokens which directly accrue value off the back of stablecoins. There's one more that he doesn't mention. This is a similar one to BNB and BUSD, which the accrual isn't as linear. That's USN on NEAR. Now, this is a similar L1 play, which means that obviously USN means TVL comes into NEAR. Like we can see on Ref Finance, the biggest DEX on NEAR, that this pool is actually the biggest already, 85 million. Like all the other pools really pale in comparison. In fact, if we look on DeFi Llama, we can see that Ref Finance is by far the biggest, but 80 million of the 213 million is composed of this stablecoin pool. So we know the power that these stablecoins have of actually accruing values for L1 ecosystems. This is why I think USN is good for NEAR Protocol, because it actually brings in new liquidity. Now, maybe in a bear market, it's harder to get liquidity than a bull market where people are more risk on, especially in a time that, USD lost peg and a lot of people lost money. There's kind of like a lot of uncertainty surrounding stablecoins, especially stablecoins that aren't centralized or aren't one-to-one fiat backed. But we know this is a fully collateralized stablecoin by USDT. They changed the backing from NEAR fully backed to USDT backed, which is, a positive in my opinion. It's obviously not as safe as just investing in USDT, but it is a lot safer than it was in version 1. And this is a play that obviously investing in USN is one way to get 14% or 17% compounding, but investing in NEAR Protocol itself would give you to the upside of the growth of this stablecoin. If you believe that USN actually gains mass adoption, then obviously, this would mean that NEAR ends up gaining adoption because people are going to need to use NEAR Protocol, meaning they're going to have to build up NEAR wallets. They're going to have to build, contribute to the NEAR ecosystem through paying gas fees, which obviously accrues value for the NEAR token itself. Undirect value accrual, it's not as linear as Maker. It's not as linear as FXS. It's probably a little more linear than BNB, but it's still one to note as potentially just an extra reason, because I don't think you need reasons to invest in NEAR. I've already stated multiple times that I'm a big fan of this protocol, but I think it's just that little extra cherry on top of one way that you can get exposure to this narrative. So I highly recommend checking out Rex thread because he does go through some very unknown or less known stablecoins that I personally aren't involved in, like SUSD and LUSD. And he actually is, saying that there's decent opportunities that are presenting themselves across these riskier ones. And he also links like the best thread of each stablecoin in this thread as well. So I highly recommend checking this thread out and just seeing if you did want to have a little bit of a gamble on one of these, smaller stablecoin ecosystems that you could. I personally think the market is shaky enough to kind of want to play it on the little bit of the safer side. That's why like BNB, NEAR, FXS, potentially Maker, they're kind of like the safer ways to get exposure. The riskier plays, they're going to give you that crazy upside. Like if a stablecoin, let's just for example say Faye. Faye is only 198 million market cap. That can easily get to $1 billion because it doesn't take much liquidity to pump that to $1 billion. If that did get to $1 billion, then obviously the tokens involved in the value accrual there would result, in massive gains because it has less of a relative gap to jump in terms of its value accrual. I'm just trying to find where he mentions Faye in this thread. Here we go. This would obviously mean, Faye accrues more value, but once again, it's a much riskier stablecoin, right? So it's kind of like one of these riskier plays that you may not necessarily want to get into this market, but it's something to just monitor. And that's not specific to Faye. That's like any smaller stablecoin that you think can gain mass adoption. So definitely some smaller cap plays that you can take advantage of if you want. I'm personally sticking to the big caps because I'm trying to play it a little bit safer given the market uncertainty and volatility at the moment. And that's just kind of how I'm playing this narrative at the moment. Just wanted to answer a few questions, guys, before I kind of jump off today. And answer some questions. I'll just go and answer a few that I'm already seeing. Pump your NEAR, dude. Jurgen, I barely own any NEAR protocol. In fact, I'm giving you guys NEAR protocol before I've even accumulated. So I ain't pumping shit. you're actually getting in before me likely because I barely have any near. And the reason for this is I'm DCAing super slow into these major L1s. I'm taking a nibble at near, but like, man, I am like 99% away from my desired near stack. Like I need to accumulate this thing, but I'm not rushing. I refuse to be impatient. I refuse to be impatient. So yeah, not pumping at all, bro. In fact, you'll pump the coin more than me because I barely bought any. What do you think of European stablecoins? Well, we did see yesterday that the euro and the US dollar hit 1-to-1 parity for the first time since 2003. So like, I don't know, not a lot of strength in the euro right now. I do actually like the concept a lot though, AM. I think euro stablecoins are something that hasn't really grown that much yet, and I think will. The thing to note that is European regulators are being very strict. So potentially there's headwinds, related to regulation there. But like in terms of like investing and holding them, this is a risky market to do so, given what I'm showing you on screen right now. Heading to Insta after this. Yeah, potentially I can if you guys want me to continue. If you would like, I definitely can. Dgen. Absolutely crazy that they're the same value. Yeah, man, like it's nuts. Like it's just absolutely crazy. The strength in the US dollar is mind blowing, and it's a good thing in many ways because commodity prices come down, good prices come down, which is positive from a Fed perspective. But overall, I think it's getting a little bit out of control. I think it overall becomes a negative because then the US's exports are financially benefiting less. Like I'm in Australia right now. We like to keep AUD low because that we export a lot. We export iron ore, we export uranium, we export coal, and we like to receive US dollars in return. So from an Australian terms of trade perspective, it's actually quite beneficial having a high US dollar. But then from a US export perspective, it becomes a negative if they're trading in other currencies. But given US is the kind of like the reserve currency, then I feel like there's less of an impact from a trade terms perspective, but it's certainly still like getting a little bit crazy in my opinion. Am I in any positions? I'm not in any. I'm in my long bags. Like I have hodl bags which I accumulate. The top stable coins, Bitcoin, ETH, definitely have like probably like 20-30 positions, but like hodl positions. In terms of trades, I'm not in any trades right now because I closed my short. I did take a little bit of a swing trade on the shorts after the break of trend, made a couple percent, but I closed it because I want to see how we react to this green box now. Now, if we do break below, which it looks like we could very, very soon, then obviously the play then becomes like break below, retest. If we get confluence of the trend and the green box, then that is a fantastic short because then you can simply just set your stop loss. Like, let's try and get a good stop loss. Depending on the leverage you use, you could probably set it at 19.6, so probably above this high, but I'd set it above the green box here, and then that instantly becomes a decent trade because like if you get stopped out, okay, maybe with like 5 to 10x leverage, you'll lose like 10 to 20% of your position, but that's a decent risk reward play considering just how much resistance is going to be in this green box, and given the fact we could break below. So just keep an eye on that trade as a short setup. That's potentially a decent setup if we do get confluence between these 2 points, because yeah, you can set your stop fairly tight and you're not really risking much capital. So like, if you get stopped out, you get stopped out. It's not really a massive deal as long as you're responsible with leverage. Remember, George, smash those likes if you are enjoying the video. Smash the like button, smash the subscribe button if you're not subscribed. Show love on the channel. We're here every single day during the bear market to support you guys. I'm just going to answer a few more questions. Keep up the good job. Appreciate it. Thank you very much. What are your thoughts on VRA? I do like VRA a lot. It's probably one of those tokens. What's it coming in at? Like $100 million market cap? $100 million market cap is like, well, maybe it's a lot less. Well, its FDV is 473. Its market cap's 50, but has a 10x FDV. A lot of dilution to come from Veracity. I would say it's priced in. I'd say considering market conditions, this isn't one I'm comfortable DCAing into yet. I like it, but it's one for the watch list, probably not one for the buy bag. Hector, appreciate the support. What's your opinion on the cycle bottom indicator? I don't really believe in bottom indicators. I mean, look, there's a few historical points. Maybe I'll do a future video on this where like weekly MAs have converged, where RSIs have bottomed out relative to like the break of trend on the logarithmic scale. A few bottom indicators which are still in play, but all that we just keep seeing bottom indicators being invalidated, and I think it's a very different market now. We've never seen the macro environment like this. So why are we trading the bottom like we were trading it in 2013? Like, this is what I really don't get from traders. It's like, guys, no chart is going to express the macro situation. It doesn't matter how many MAs are crossing or how many support lines and diagonal trends are converging. It's like, it won't matter. It won't dictate the bottom until the macro scenario sorts itself out. Like, that's just the reality of the situation. So anyone saying they've got some golden bottom indicators lying. I do think there are a few which are definitely important to note. Probably something for a future video, but it's not something that I hinge my entire crypto trading off. In fact, I'd much rather trade off the fundamentals when it comes to a bottom. Like, I'd much rather trade off a Fed pivot and a stock market reversal than I would off some stupid RSI or some volume spike. That's just personally like how I trade, right? Josh, what's your question, bro? There's a lot of comments, so it kind of gets lost if you don't repeat it. Got to repeat the comments, guys, if you want me to answer them. How long's this bear market? I mean, this is a question that, you know, a lot of us would love to answer accurately. I mean, you can make the argument we've almost been in a bear market for a year. If you look at the logarithmic, you can also make the argument May was the beginning of the downtrend. I personally think it was November, but you could argue it was May. But, you know, regardless, we are approaching the year mark of the bear market. We know that bear markets can last a couple years. We know that historically we've bottomed around like a year and a half. So that could indicate like 6 months till the bottom if you're using previous data as a way to substantiate when the bottom will be. However, this market can change very quick. Like, I would not be surprised if a Fed pivot resulted, you know, in a massive reversal. This obviously means we can get massive downside in the short term, 100%. But, you know, we've seen a much quicker drawdown than in the past. Like, this market is crashing quicker. And when it crashes quicker than the past, it means it also rallies quicker. So just like we kind of had this slow bleed in 2017, we aren't seeing that now. We're seeing a quick bleed. Now, we know just as things go up, they come down, and just as things come down, they can go up. So a pivot here, although potentially 6 months to a year plus away, could be a long time, don't get me wrong, but a pivot here would result in a much stronger relative rally due to the amount we've come down. So just keep in mind that looking at previous cycle lengths isn't necessarily the best strategy here, although a lot of traders will tell you it is. I don't necessarily think it is, to be completely honest. How can you say that? How can I not? How can I not say that? The market has clearly crashed a lot faster. Why wouldn't it pump faster? It's just logical. It's the law of diminishing returns when it comes to percentage pumps, and it's the law of velocity when it comes to these macro swings. This is the most volatile the macro environment's been in many, many years. So you'd be remiss not to consider the fact that a macro pivot would result in a major change, not only in the crypto markets and in the stock markets, just as negative news would similarly impact it in terms, of its relative velocity to the downside. So I can completely say that, and it makes complete sense. This is different. That's exactly my point. It is different. It's different to previous cycles. So my point is, since it's different to previous cycles, it can also rally faster than previous cycles, and we're not necessarily stuck in a 3-year crypto winter. It's exactly my point. You're just backing up my point. No pivot, only bull. I mean, look, if we zoom out long enough, if we go to the monthly, we're in a bull market. Woohoo! Let's draw in the trend line here. Look at this. Look at this, guys. It's a bull trend, guys. We're definitely in a bear market, although, you know, when in doubt, zoom out, right? But I guess zooming out to the monthly only really applies to people that got into crypto in like 2015, 2018 bear market, because those are the people that are still net up on their investments. Because unless you were trading, most of you likely would be net down on your investments, just because these are the lowest the prices have been since 2020, right? So that's just kind of like goes without saying. Look at the dollar. This is a very interesting discussion, Jürgen, because if you look at the dollar, the high DXY actually indicates lower commodity prices. So although historically the DXY has been inversely correlated, we know right now the Fed's main priority is to bring inflation down. Now, if the Fed's main priority to bring inflation down, then lower oil prices, lower commodities, lower energy prices would result in more of a license for the Fed to actually pivot, and it would apply to the CPI data next month, because that's when the relative pricing today will come to fruition. So looking at a pumping dollar is actually, although traditionally a bearish indicator for crypto in the short term, given the inflationary environment, I don't necessarily see it as a negative thing. Now, long term, yes, it's inversely correlated, but let's just keep in mind that we're in a very unique scenario, and we do need inflation down before the Bitcoin price has any sort of license to rally. So if that becomes the priority, then a rising US dollar is not a reason to like start crying and panicking. It's actually a reason to at least, be a little bit confident that there is light at the end of the tunnel here. Yeah, I'm not going to reply to dumb comments anymore, because some of us research and some of us comment. Like, that's the difference. They're stuck fiscally completely. It's like a total catch 2022, right? You can either keep pumping money into the economy and run the risk of a recession later, or what they're doing now is tighten, run the risk of a recession now, but then obviously long term that is much better from an employment perspective, from a severity perspective in relation to the housing, a potential housing crisis. But yeah, I mean, they're in a catch 2022. They did this to themselves. They dug their own grave, and now we're seeing the repercussions. I'm just glad that it didn't go any further. Like, you got to look on the bright side and look, if QE went any further, maybe Bitcoin would have hit 100K, but then it literally would be 5K now. Like, it just would have totally tanked, because the impact would be so much worse during the next recession. And I know, given a lot of the lessons we learned last cycle, the likelihood is, even if Bitcoin did hit 100K, most of you probably wouldn't have taken profits, and that's not a mistake any of us will make ever again. But it was a mistake that was heavily made in the last cycle, and in a way, it's probably lucky that things ended out like they did from a learning perspective, purely from a learning perspective, not from a financial perspective, because I know like a lot of us are hurting financially. Although trading's giving us a decent way to actually profit in the meantime. Remember, if you don't want to trade, link in the description for a ByBit account. Support the channel, support your boy. So this show's getting kind of long. So what I want to do is go onto Instagram for the rest of the Q&A, because there are still more questions coming in. Jürgen, I literally talked about the Fed the entire show. The entire show I talked about the Fed. All right, so you guys can go onto Instagram, and I'll continue the Q&A, because there are more questions, and I don't want to make this show 2 hours on YouTube. So I will continue answering your questions over there. There's a link in the description if you want to join me. Just for a bit of fun, I do follow people back. So if you follow me on Instagram, I'm going to be following, let's say, 15 people back as a show of support if you go and follow me on Instagram. So yeah, link in the description for Instagram. I'll answer all of your questions over there, and we'll kick off the live stream kind of where we're leaving off in 30 seconds over there. So yeah, thank you guys so much for the support. I will see you in tomorrow's show. Hope you enjoyed the show, and I will see you over on Insta. Have a lovely day. Peace out.